Where a couple years ago, Michael, I would have been like, I'm not buying another single family house ever because I can make way more in multifamily. But let me tell you, multifamily is a bloodbath right now. Investors are getting crushed because of the prices and the short-term bridge debt coming due, and the values on paper have fallen because interest rates have gone up. Multifamily has gotten crushed. And so they're very different animals, and what you want and what you need is different. But the key to both of them is you don't overpay and you use debt that you can lock in as long as possible. And if it cash flows and you need income, it's a good deal.
What would 8% mortgage rates mean to the real estate market? What would high rates, call it 8.5, mean for investors in residential real estate? What do high rates mean for the hangover in Class B and Class C multifamily? It is going to be an interesting year. As if you don't know my call on 2025, it is higher for longer. In the residential space, we will do less than 4 million transactions, so worse than 2024. I believe there will be a lot of pain coming and, more importantly, recognized. But all of that said, what should an investor do? Should we just forget the market and come back in 26? So we're going to have a conversation with the one and only Anna Kelly about what investors should be thinking about today with high rates and the potential for a significant correction in multifamily Class B and C. Anna, lots going on.
It is. And, it's really difficult because I hear so many investors, both coaching students and people in the space that have been doing this a really long time are struggling, right? Struggling to find deals that make sense today. And we've been in this really, people don't recognize how big of a shift what we've been through the last couple of years is from the last 15 years. And so, investors tend to have a hat. And I learned this back when I was in private banking that doesn't go back their memory further than about 10 years. And so whatever things have been in 10 years, they just expect that it's going to continue that way, minus a few blips here and there in the world that might cause some very short-lived economic pain. But for the most part, we went through about 15 years of historically low interest rates coming out of the great financial crisis in 2008, 2009. Rates were held so low that investors didn't have to make a really high return on their money to be happy. Because, right, if you put your money in a CD or a savings account, you might be lucky to make 1%, maybe 2% in certain longer term CDs. But when the treasury rates were low and the Fed funds rate were low for so long, it incentivized people to stop saving, right? They're not paid enough to be savers, and to start investing. But when the risk-free rate of return, that U.S. Treasury is in that 2% range or lower, even up to 3%, it incentivizes investors to go, that's barely above inflation. I've got to go buy other stuff that gets me a better return. And so, before COVID, most investors in real estate were really happy to make about a 6 to 8% on return on their money. For a while after the GFC, everybody wanted a 10 cap, meaning if you paid cash, you want a 10% cash on cash return. Essentially, it's the easiest way to think about a cap rate. But as the economy stabilized and we got in, past a recovery post GFC, and we got into really a very long expansion period, interest rates normally would start going up. The Fed held them low too long. Normally, interest rates would go up, and then therefore, even though the economy is doing better, you're not going to have huge returns relative to that risk-free rate of return of the Treasury. So what we say as investors, and I'm always trying to get investors to think about this, whether you own one piece of real estate and you're looking to buy another single-family house, or you're investing in the stock market or bonds or big syndications, it doesn't matter. You need to ask yourself, is the risk premium for the risk you're taking to own that asset good enough, the return on your money good enough for the risk you have to take to make that return? And that should be your mindset all the time. So because of this artificially low interest rates held for so long, we got used to being able to have a decent risk premium. So you invest in real estate, maybe you have a 3 to 4% return over the U.S. Treasury. If you go in the stock markets, you want a 6-7%, return over the U.S. Treasury rate in general. But what's happened with all assets, whether it's the stock market, whether it is real estate, or just about whatever. Look at Bitcoin, etc. We have a historically low risk premium that people are actually getting paid for taking the risk of owning investments above the US Treasury. And what that means is that you find it really hard to find deals that work in real estate. That's just the reality across asset classes, some doing better than others, some doing worse than others. But you're finding it hard to make any cash flow, okay? But because the interest rates are so high compared to where they used to be. We used to really make a lot of our return, Michael, not in the low price that we got, although sometimes that happened. But a lot of us made great returns because we got such cheap interest rates that we were able to really get a lot of cash flow, which gave us a great risk premium returns, even better than if you had paid cash. You just put more debt on it and you make more money. Well, because interest rates are being held high by the Fed, and we're well above neutral, they're too high. They just are, in my opinion, right? You cannot finance properties without your mortgage being significantly more expensive than what they were a couple of years ago, which means you're basically every dollar more of debt you put on a property, you make a lower return now. And that's not what we've been used to for 15 years. So investors are frustrated, but it's really a component of where we are with interest rates being so drastically different that's making things not make sense. So I'll kind of pause there. There's so many ways that we can take this, but it is a mistake to say, I'll just end with this real quick. It's a mistake to say, let's just get out and we'll get back in 2 years, because at the time that it's very difficult to make really good returns and a good risk premium, a good enough return relative to the risk you're taking. Many investors do exactly that. They leave the market. And therefore, you have to understand that when everybody else runs away because they can't make it work or they're afraid, that is the maximum point of opportunity for you, because you have so much less competition. And when it comes to people trying to sell these investments, and let's just talk real residential housing, there aren't enough buyers that can afford to buy them, whether they're a homeowner or an investor right now. So they're all on the fence, which is why our transactions are at historic lows, one of the lowest transaction markets we've had in real estate. So this is the opportunity for you to find many motivated sellers and try to figure out how to get creative to make deals work, to get enough of a risk premium. You're going to have to kiss a lot of frogs, as they say, and toss them back into the pond before you find that prince, the proverbial prince or princess if you're a guy, right? But it is the time to do the work, to find the motivated sellers and to try to create win-wins. And deals can get done. Deals are getting done, either price or terms, seller financing, which I talk a lot about. It's a mistake to pull away because we don't know, Michael, is this the beginning of a new era of high interest rates for years longer or not? I've tried to figure that out. My timing has been off, and so many things have changed geopolitically that make what used to be the norm of what we could expect the Fed to do in fiscal policy kind of thrown out the window. So I'm a big believer in you can make money in every market. There are going to be markets where you're just killing it, and the economy gives you what you need to do tons and tons of really good deals. And there's markets like where we are, and quite frankly have been the last 2 years, that it's really difficult to make good returns. And that's just the reality as an investor. But you can make money in any market, and you just have to be patient enough to only do good deals for today relative to what kind of returns you could make in other asset classes. And if it doesn't make sense and it doesn't meet your financial goals, and if your financial goals cash flow, then you hold off. But if you can get creative and make something happen, you'll be handsomely rewarded over time.
Yeah, that's what I want people to hear from this conversation is, every day that goes by that rates are over 7 and if they go higher to 8, it just means opportunity. I mean, I want to remind people of 2021, right? 2021, again, residential, very low inventory, but people were frankly doing stupid things, right? 50K over asking, releasing EMD funds day one, so it goes hard, waiving inspections,
Especially
all
in
of that.
commercial.
Yeah, just crazy stuff was going on. I know it feels good. I know the energy is there. But that environment is actually extremely risky.
Yes.
right?
Yes.
And when everybody is rushing in, frankly, I rush out and have videos on this channel to prove it.
Yeah,
I
we've talked
sold.
about this. The
Yeah.
maximum point of FOMO when there's this irrational exuberance when everybody says we can't lose, this is the thing. That should be a warning sign to you that the market is driven by fear of missing out
Yeah.
and being irrational. And that's the maximum point of risk. Where the bottom, when everybody's already rushed out, that's the maximum point of opportunity.
Yeah.
But we're so psychologically rocked by the fallout of the FOMO at the peak that it takes some people years to get off of that fear to where they're willing to go in for the opportunity when it's there. And that's and it's really tricky to figure out, are we at the top yet? And are we at the bottom yet? So it's not easy even for us experienced, older seasoned investors to figure out the timing, but we see the signs and you saw those signs. I saw those signs. And that was our time to go, hey guys, like slow it down, only do good deals. Don't do bridge debt, lock in your loans. Like we've been preaching that for a couple of years to the point that people thought we were being too conservative.
Yeah.
And now everybody's so afraid because they have lost money,
Yeah.
right? And our investors have lost money. LPs, GPs, whether you own your own, whether you've syndicated, I've lost money in deals that I put in as a passive investor for operators that were really good, but the timing of the market, didn't give them what they needed. All kinds of alternative stuff as well. I win some, I lose some. But the reality is now those people that called us way too conservative, Michael, what do they say? You're crazy. You're going to get people in trouble. You're taking on too much risk. You're telling people to be too risky. And it's like, no, this is the point when the pain is sufficient enough that you can start getting some deals done. You just got to realize we might not be at the bottom yet. And that's why we say only do deals that actually meet your financial. Like if it doesn't cash flow today, don't bank on rates going lower to have cash flow because they might not, right?
Yeah. That's exactly it, Mark. When I think about investors in our community in 2025, I have never promised closing a deal. To me, the measure of success isn't actually closing a deal. To me, measure of success is knowing what a good or great deal is in your buy box.
Yes.
And the beauty about the market we are in and likely going forward is your odds of getting a good or great deal are actually going up as every day goes by. Why do I say that? Well, just watch days on market. We just reported days on market today in our daily financial news are 78 days. That is up 20% year on year. And it's going higher. That is a great thing if you are doing the work. You know what a great deal is. You write disrespectful offers. You follow up. The numbers are on your side. Demand is going to crater at 8% mortgage rates. In fact, I think the only people that will be buying are the lucky few that have cash and then investors who go, hey, I'll take my shot. Now, how do you get 78 days on market when it used to be 50? The answer is two ways. One, you have what's called stale listings. I've termed these people wish pricing. Yeah. They reach out to an agent. They say, hey, I'll sell my house at 330 or whatever the number is, but I won't take a penny less. Well, in today's market, the home's worth 300. So that property is going to stay there for 330. It'll get a little action the first week or so, and then it will do nothing, crickets.
Right.
That listing is still on the market. It will be on the market until that listing contract expires, which is either 90 days or 180 days typically. Now, that is some percentage of your market, your buy box. Mm-hmm. Your job is to figure out what percentage. It ain't zero and it's not 100. Mm-hmm. It's somewhere in between that. But here's the other angle. The other thing is you have motivated sellers. They need to sell. Yes. They've had a divorce, death, transfer, downsize, whatever it is. There are lots of reasons you need to sell versus want to sell.
For sure.
And again, every day that goes up and you are a seller that needs to sell and your house has been listed for 78,000 or 78 days, you get more motivated to either A, take a big price drop, or B, do a creative finance deal. Now, yes. I'm talking about these in residential, but they apply to commercial as well.
Yeah.
If not even more, because you could add on the risk of debt, right? The debt could be coming due, and that that is a kind of pressure that you don't want as a seller. So again, as a buyer in the market we are in and likely getting better, I will say this, Anna, I love 8% cost. If I had my druthers, let's go make it 10. Let's go. Let's go to get 10 and I will go ham.
Did you hit your head?
Well, I sit here as one lucky guy who has 30-year debt on everything. So I don't care if it goes to 10.
I'm just teasing you. We
know.
can do that after all these years, right? But I can tell you, I liked the 3% Fed funds, or lower Fed funds rate. I liked the 3.5% and 4% mortgages. I just lock them in a little longer. So I think I'll always pick those lower rates if I had my choice and the economy was actually stable than 10. Only because there's so many more deals on the market and I can finance them all to make them work. Where at 10, there's less deals on the market, but less competition. So neither is horrible as an investor. To the point, I would say this. I'm like totally opposite of where I want them to be. But in both cases, we have something good going for us. When interest rates are super high, so many motivated sellers, like they're just going to have to slash prices. And so you get a better deal on the price. Where low interest rates, you get a better deal on the financing. So.
Yeah, it's and again, I don't know that I would wish for 10% forever, but I just, what I am looking for now, and again, this happens in every cycle, we need a forcing function or a cleansing. I have said for a long time, there were a lot of bad deals done. And there's only a couple of ways to fix a bad deal. One is time. You just hold it longer. Eventually time cures all bad deals or most bad deals. And the other one is you just blow up the whole structure and you force banks to stop extending and pretending, and then they become the forced seller, and we get out of this thing. I think 10%, and again, I don't think it goes to 10, but it might go to 8.
Yeah.
I think there's an 18-month period where we just go, okay, who was swimming naked? Who was making money because of 3% rates, and who's a bad operator and who doesn't know how to put together a deal structure? Wash out a bunch of losses, which will be painful, undoubtedly.
Yeah.
There will be people that never come back because real estate is bad. No, your deal was bad.
Mm-hmm.
And it was bad day one. Oh, by the way, we just realized the pain today. But as a guy who has picked through the garbage in past cycles, I have no problem doing it again, and I have no problem in 8 or 9 or 10 doing it again. In fact, it's actually, for me, as someone who's not full-time and not a big shot like you, I have more success at high rates than low rates. In low rates, I just see all these idiots coming off the sidelines, and I'm like, I'll sell you some of my junk. I mean, I remember selling a 13-unit building that needed like $200,000 in immediate money that should have sold for an 8.5 cap. It sold for just under 6, and it needed all this money. I'm like, great. I'm somebody else's problem now. So
I sold a bunch of stuff this cycle too, right? Right around 2021, right about that time post-COVID when things were going nuts, 2021 into 2022, I was like, these prices are ridiculous. So the same thing, I sold my older properties and I traded them up for newer properties, newer than the ones that needed less work. And I got such fabulous interest rates that they made crazy returns, because I was able to leverage them. But, I think it also depends. And this is why real estate, it's so important. And I love that we talk about both residential and commercial because they're very different animals, even though they have a lot of the similarities that make them great. Number one, you're providing residential housing to somebody. Now I'm talking multifamily and single family. Let's, not talk about storage, office, industrial, manufacturing. All that stuff is kind of a different animal. But what I love about residential real estate, providing residential housing to people, is it is an essential need. And that is why, whether you're in a single family or a small multifamily or a large multifamily, over the long time, people will pay to live in your property. You're going to always have demand that fills your property. You're always going to have loans available to you from the federal government because housing is such a need. And therefore, you have the ability to lock in longer term interest rates, which is so important. And really the problem with so many of the deals that have fallen out in multifamily in particular are not because of the asset class being bad or you necessarily doing a bad deal, but it's the bad financing, the short-term debt that you put on them coming due that really wipes people out. But I love residential housing, whether it's single or multi, because it's a need and there's good financing generally available for you. You don't have to go do the bridge debt. You can lock in, for residential, sometimes 20 to 30-year loans, where on commercial, a little bit bigger multifamily, you're only locking in 5, 7, 10 years. 10 years is pretty good, but a lot of people got burned even by just locking in for 5. And, I've been doing this a really long time, but I never saw interest rates going as high as they did for as long as they have. And there are deals that I locked in for 7 years as I was getting closer to seeing the writing on the wall. But there's many deals that I locked in 2001 that I wish that I had done 7 to 10 year locks and paid a little more for those locks, and I didn't, right? So I've learned that lesson. Next time they go really low, I'm going to lock in for 10 and pay half a point more. But the point being, even though you've got the fundamental soundness of investing in residential real estate, you've got the tax deduction, you've got usually some cash flow, equity pay down, appreciation, you can use leverage. All those things are beautiful things. The big difference between residential and commercial, and probably some of our differences in what you like versus what I like, right? You made a lot of your money on single family. I started in multifamily. I mean, I flipped a few houses and I still have some residential houses, but I've always kind of gone for those multi-units for most of my investing where I could force that appreciation. So the debt that I put on the property was the most important factor to me in being able to get more leverage, to force the appreciation, to have instant forced equity that I could then go tap and then refinance or roll that in, put a second mortgage on one property, use its equity as the down payment at a really low interest rate, allowed me to create astronomical returns that I couldn't have made on single family as easily, because it's harder to kind of force the appreciation on a bunch of single family houses where there was always a lot of competition in multifamily, but it didn't really, it wasn't a lot of competition when I started on the lower multi-units, because most investors either start with single family or they're convinced they need to go to big multifamily. So those units that are like 4 to 50, 60 units, maybe even up to 70, there weren't a whole lot of investors I was competing with. So the competition part wasn't as big of a deal to me as the debt. Where on residential, and this is where we are as well today, prices have gotten so high that, and interest rates now coming out are allowing you to have more opportunity. Where I had a lot of deals available to me the last couple of years, residential didn't have as many. Why? Because rates got so low that you had so much demand that even whether you're a flipper, a wholesaler, trying to buy and hold, or someone trying to buy a home, you could not buy them without going way over asking. And so it's been hard for people to do deals from 2000 to 2022 because of all the competition. Now the prices have gone up and they haven't come down a lot yet. So your best case scenario, if you're a single family home investor, is to let the washout of all the demand go away. And therefore now you're one of the only offers that motivated seller gets. And that's wonderful for you if you're investing in single family houses. And so, I've only done, just to keep it real on this show, I have done 2 deals in 2 years, Michael. 2.
Yeah.
That's the lowest I've ever done. I used to do 2 in a month.
Yeah.
So, 2 in 2 years. One is I'm very principled. I'm at a place where I don't have to do deals to meet my financial goals. They're all kind of gravy, right? So it's like, if I find an amazing deal, I'm going to do it. But if my risk premium, back to our opening segment, isn't enough where I'm being paid a good enough cash on cash return versus putting it in a money market and making 5%, I'm principled enough not to do the deal. But are there moments when I'm like, get it together, Anna, like you're a loser, you've done 2 deals? Yes, I have those moments, right? We all do. But the reality is you have to be very principled. It's exciting though. I bought one of those 2 deals was a single family house. I hadn't bought a single family house. And actually I've done 3 deals in 2 years, if you count the house I got for my mom. So, but I bought 2 single family houses and 1 multifamily house in 2 years. And the reason I was able to make it cash flow and be an amazing deal is because, one, I bought it from a seller who was for sale by owner, didn't know what it was worth. I got it for well below what it was worth as is. He had completely redone it because he lived in it. So 100% redone. I got it about $40,000 of built-in equity. It's right behind a major hospital system where I can midterm and short-term rent it and get top dollar for rents. And I went out to one of my private lenders who's also looking for yield. And I said, hey, you've lent money to me before. I found a single. Would you be interested in doing a private loan? And so I did the private loan at 6% interest only. Because it's interest only, it allowed me to cash flow. And it was an amazing deal. Where a couple years ago, Michael, I would have been like, I'm not buying another single family house ever because I can make way more in multifamily. But let me tell you, multifamily is a bloodbath right now. Investors are getting crushed because of the prices and the short-term bridge debt coming due, and the values on paper have fallen because interest rates have gone up. Multifamily has gotten crushed. And so they're very different animals, and what you want and what you need is different. But the key to both of them is you don't overpay and you use debt that you can lock in as long as possible. And if it cash flows and you need income, it's a good deal. Yeah. If it doesn't cash flow but $100 and you need interest rates to go down for it not to, and you can't afford any prices to go up, and you can make 5% in a CD, then I'd say it's not a good deal, right? Yeah. So you have to know yourself, and you have to be diligent and do the work. What I have not stopped doing in the last 2 years is looking at deals. I look at deals consistently all the time. Single family, small multis, large multis. I look at the deals. I look at the debt available. I try to make them work. And you know what? Most of them have not worked for me, Michael. Yeah. And that's nothing to be ashamed of. So I say that to encourage, our listeners, because I know you do the same thing, to say, don't give up on doing the work. Real estate is not suddenly a dead asset. It's one of the most important assets that you can own and that you can provide as an investor to other people that need good housing. But you have to continue to do the work and not give up thinking this is fruitless, because all the work that we've done over the last couple of years, and you and I are very experienced, but a lot of newer investors who have started, on this channel and in your school community, we've done some Q&A, who got their first deal, got their second deal, got their third deal. They did it because they didn't give up and they were diligent. Yeah. And so doing that work, even if you didn't find a deal, is making you so much better of an investor today, that when the opportunities really are there, you're going to have gone through all of the pain of, making stupid offers and being rejected and not knowing what a good deal looks like. And now you're going to be prepared that when all these other investors are gone because they've given up, you're rocking and rolling because you've done the work.
Yeah. The question I have for you, because again, you play in a space that I don't, is I think we all see the writing on the wall. I think you're right. I think there's a lot of pain in the multifamily syndication space. I just don't know how long that fuse is. I think the fuse has been lit. Yeah. I think last year there was a general feeling like, hey, we might be bailed out because rates are going lower. I think that now has generally been washed away. I think if the articles I've read are correct, I think we had a $1.5 trillion in debt pushed from last year to this year, right? Kind of a 1-year extension. Now I think there's something like 2.5 or 2.8 trillion in this debt, this bridge debt coming due. And it looks like Class A is retrading. It looks like Class A is retrading at about a 25 to 28% discount. But Class B and C, Anna, not frozen, rock solid, no price discovery. I'm curious, what are you seeing?
Yeah, there's a couple of things. I mean, survive to 25 was the mantra, right? By 25, interest rates have to come down. Inflation's coming down. The Fed can't afford, the Treasury can't afford to keep issuing bonds at high rates. The government can't afford to fund them with the tax dollars coming in, like all those things saying rates, we're going to have a recession, so rates are going to fall. So the hope and fairly realistic at the time was survive to 25. If you can get if your debt doesn't come up until end of 25 for renewal, rates resetting, or a bridge debt, then, or you could get your lender to extend your short-term loans a year or two. Then if you just make it to 25, you'll be okay. And so we've seen a huge washout of investors who've had to turn over the keys to their loan because the values on paper, again, this is really important. The values on paper, because a value and a cap rate has to give you a risk premium above the Treasury. If the treasury was at basically 1 and you could trade at a 3.5, 4 cap, meaning 4% cash on cash return if you bought it for cash, and now treasury's at a 4, then you're going to need a 6 or a 7 to make that deal work for investors. So cap rates went up, means values fell on paper for the temporary term 30%. Well, those that needed to refinance and those who still need to refinance, Michael, have a deal that is on paper worth 30% less money than it was when they took out the debt, which means they owe on it what it's worth. Yeah. And loans basically have covenants that say you have to keep your loan to value the same when you refinance and at all times. So at least that. So if you had a 70% LTV loan, you had 30% equity. Well, if now your equity is 0 because the value of the loan is the same as the debt, they're going to either say, sorry, you're in default, give us back the keys. And then the lender's going to try to sell it, make a profit somehow. Or they're going to say, maybe we'll extend that loan for you 1 year. But the banking regulations don't allow these banks to just ignore their loan covenants. And if they've been sold as a mortgage-backed security, they can't change their loan covenants. So the lender's in a pickle because the lender doesn't want to write off that loan because it could make their assets fall and banks fail because they're illiquid. But the investor really can't sell it and they can't refinance it. And so a lot of lenders did, and the federal government, this didn't get very much news, but allowed the banks to wipe out their reserve requirements and to make some extensions. They put out a press release, the Treasury, to try to work with your commercial real estate loans so that we don't have the fallout. And so that's been kind of pushed under the rug, but a lot of banks did extend for 1 year loans. So they're up for renewal. They said, we're just going to ignore the fact that they're worth 30% less. As long as you keep paying, we'll let you keep that mortgage for 1 more year. Or they made them cash in refi. You give us a check for $5 million and we'll refinance your loan at a lower principal. But the problem is that's coming up. And so to your point, there's been a lot of pain. There's been a lot of losses. There have been investors wiped out, a lot of foreclosures in multifamily and other commercial real estate that's cap rate driven. However, the bloodbath isn't over because all of those loans that got extended have to be extended again. And the question is, will the banks be able to do it? Will the government allow them to do it? Will the regulators allow them to do it? Or will they say no? And then we have that washout that you were talking about, where not only do a lot of commercial real estate owners lose their property and investors lose their equity, but the banks start to fail because they're forced to write off the bad debt.
Yeah, well, let's talk about that.
That would be horrible. But just real quick before we go on there, my little mantra has gone, and I think I coined this, but survive to 25 is like pray to heaven you make it to 27 for commercial real estate.
27.
That's right, because the reality is things have changed. And despite the fact that I believe, and no, I'm not a MAGA doomer, but I believe we are in recession. It hasn't been declared. I think it will be this year. And rates will probably fall, and that can soften the blow of the potential fallout. But, we had 2 Fed governors come out this week and say the economy is still pretty stable. Inflation and jobs are kind of balanced. We have no reason to rush to cut rates. And if the economy stays fairly stable from whatever government manipulation of numbers, and we have GDP just stay above that 2/4 of negativity, and inflation doesn't go super high, but it stays higher than what they want, rates are going to be higher all year long unless a recession is declared. And if rates are higher all year long, all these people that needed to survive to 25, they're not going to have the chance to extend into 26 and 27. Nope. A lot of them will not. And so, if the Fed dot plot is right, and it never has been, Michael, but I'm just going to play out, a scenario. If their dot plot is right and they're more hawkish at this point, and they keep rates higher for the next 2 years till they don't think inflation will hit 2%, their goal for 2 years. That's what they've said. So if they don't think that's going to happen till 2027, then it's theoretically rates could stay, the Fed funds rate, which drives more of the commercial lending than the Treasury rate does, could stay high. And if banks cannot extend and pretend, then you will have a significantly more properties going into foreclosure 2025 and 2026 than I think what we've even seen through 2024. It's a potential scenario that could play out.
Yeah, that's actually exactly where I was going to go. I know there's a lot of pain. I mean, I hear it, and this is not my world, right? I hear it directly from LPs and GPs.
Yeah.
I can't imagine, what you hear, given that this is your world. But because again, I've been through the last cycle, and what I would call today is the early pain. These are the horrible deals that are getting foreclosed on, like that gentleman who lost a bunch of properties in Houston. They were D-class properties,
Yeah.
and you deserve to lose. You overpaid. But I would tell you, if I were to think about the bloodbath that's coming or potentially coming in this space on a scale of 1 to 10, 10 being the worst, I think today it's like a 2 or a 3. I think a lot of people in this space are like, no, 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 Michael, it's an 8. I'm like, I don't think so. I don't think you really haven't seen banks in mass be difficult to work with, right? They kind of gave you that year pretty easily, right? The Fed actually, or the Treasury recommended.
Yeah.
They don't have to do that. And I think they gave it to you because everybody believed that rates would be lower in a year. They're like, okay, if we have to take a loss, it'll be a smaller loss next year. Let's just get to next year.
Yeah.
But to your point, if it's now 27, they ain't extending 2 more years. They're just going to be like, eat the pain right now. Because the other thing that I think it needs to be recognized is this is not the GFC. The GFC, when assets were foreclosed on, the average loan was 97% of value, right? Originated.
Yeah.
These loans in commercial are 70, 65.
Yeah.
So we talk about banks failing. I don't know. Yeah, I don't know, right? They have loan loss reserves and somebody else is on the hook for the 30 or 35.
But here's the thing, and this is where we could do a whole nother episode just on this topic, because there's so many. My brain is firing on all these different places of, but what about this, and what about this, and what about this? So there is a lot of nuance to commercial real estate, and so I'm really careful not to like paint with a broad brush, although it seems like that when we have a few minutes to talk about something, right? But the reality is, and you touched on this, there is a big difference between Class A, Class B, and Class C, and Class D. The type of financing that was put on those properties, the strength of the markets that those properties are in, and the type of operators that you've got, right? And so I will just say this at a high level. Multifamily and operators are getting a really bad rap because of guys like Jay Gajavelli, I believe his name was, that had the huge portfolio of Class D, Class C minus properties go bad. But that's not
quickly. He went bad
very quickly. But that is not the vast majority of multifamily properties out there. And so it's what meets the headlines because so many people lose a lot of money. But I can tell you that there are really, really great operators in good cities that are very cautious and conservative when they did deals, but in a world where we didn't foresee. And I'm one of them. I'm not immune to this pain. I've got a couple properties that we're asset managing the heck out of these things to keep them stabilized for our investors. And we have fixed rate Fannie Freddie debt on our multifamily deals, which is what saves us. It's what saves us is we didn't go the bridge debt route, because those that did bridge debt, even good operators, were convinced by the Fed themselves, who said, we will not be raising rates, to take on debt and do it for 2, 3, 4, 5 years, because they were told rates are not going up. So I blame the government as much as I blame operators. But in hindsight, everyone looks like an idiot, that overpaid and didn't lock in interest rates. But I will say this. For the most part, if you're in a major city with a lot of really good demographics, good jobs, low crime, the things that I preach about, whether you're buying a single or whether you're buying multifamily, for the most part, your deals are doing well. But the double whammy is not only that you got short-term debt, because again, commercial real estate can't get any longer than a 10-year lock. And the only way you got a 10-year lock was with an already stabilized property that already didn't need a ton of work and was already 90% occupied. And that's why they were able to get government loans. So those that have Fannie Freddie government loans, which are only offered on multifamily, not on office, retail, industrial, those operators are in pretty good shape, Michael. And there's not going to be a huge fallout of those deals. For the most part, those are Class A and Class B deals. Because if it's a Class C deal, in terms of its deferred maintenance, they couldn't get those loans. They had to go
Correct.
bridge because there was so
Yep.
much work that needed to be done. If it's a Class C average income area, but the property was a stable, fairly updated property, they could get Fannie Freddie. So there's even nuance between Class C, right? Some Class C in a really good area, but they're just like middle income 1980s stock properties. If they got that longer Fannie Freddie loan, they're going to be just fine. The issue is
help me
to sell those properties to
Yeah.
new investors who can't get as good of debt as what they had on those.
I love all of this nuance, but let's try to break it down to something that I and likely audience can
Sure.
take a bite out of.
Sure.
And that's this question: what percent of the transactions, I don't know, 21 to 23, were able or of quality to get Fannie Freddie versus not? Because that's really what you're trying to tell me, right? I think what you're saying is, hey, the
Yes.
stuff that goes Fannie Freddie, 10-year lock, don't worry about, good to go, likely fine.
Right.
The other side of the coin is your only option was bridge debt. You probably got an IO, interest only. You probably didn't lock in your rates because it was too expensive or whatever.
Yeah.
And they're in trouble. So the question I have is, okay, of the entire pool, let's just say there were 1,000 done. What percent don't have to worry about most likely? And what percent is, ooh, go look for those?
And I'm going to tell you the honest truth is I don't know. And
Of
I think
course,
it varies
nobody
because
knows.
it varies. Number one, a lot of states don't have discovery, so the loans are not registered. So like I play in Texas. Texas is a state that doesn't have to disclose sales price or the debt on those properties. And so it's really hard to get price discovery there other than lots and lots of transactions and the broker saying these traded for this, because the broker's the one that sold the property so that they know. So I don't know the answer to that, but I will just say this. It's the reason it's very difficult to know how bad is the fallout going to be is because we don't really know how many for sure of these loans. And it's very market specific actually went bridge. Now, I will tell you this, Class A properties, which are trading more because big funds are paying cash and buying them for what they believe is a discount because they're trying to buy them at replacement cost or less. And if you can buy them at replacement cost or less and hold them and not have debt that's constraining you to have a short-term hold, these funds can say, we'll hold this new property for 10 years. And then if the cap rate goes down and the value goes up, we'll sell it then, right? But they don't care because they don't have a rate that they're locking in and having to worry about where interest rates will be in a couple of years. So Class A brand new properties, and Class A, I'm saying new properties, new builds in a major market like Dallas, Houston, Raleigh, Phoenix, like major hubs of employment, those are the ones trading. But you get a little 30-unit Class A in, a tertiary market somewhere, those aren't trading because and here's the thing.
There's only one buyer. Yeah.
Right. The builders had variable rate debt. So the builders, the reason there's a huge discount in Class A is because they're just like, if you're Class A, it's all bridge. It's essentially bridge debt because it's a short-term loan, construction loan at high rates. So there's a lot of distress, honestly, in Class A, unless it's a brand new property with low supply in a major market. And so that's all that's trading. So A has pain too, especially if you're in a tertiary market. The point about market size, the bigger the city, the better those Class B deals are going to do. Also, because you're going to still have some syndicators that are willing and able to take on those loans to get loans, buy at a discount and hold on. Others are going to be able to refinance into a Fannie Freddie product because they bought the B to force appreciation, just like flipping a house. If they've gotten through their value add and they've renovated those units and raised the rents, their value of their property is higher today than it was when they bought it because they forced that appreciation. It's not as high as they wanted it to be, but they likely can go refinance those deals now into Fannie Freddie and hold on. I have a lot of investor friends that are doing that. So some of that will be fine. Where the real pain is going to be is all these people that bought in tertiary markets, whether A, B, or C. They weren't major markets that have a lot of investors and loans. Number two, they didn't get through their value add deal. The properties are still in bad shape. Now they can't raise rents. They can't afford to renovate the units like they thought they could. Insurance has gone up. and you've got a low cap rate. That's where you're going to have a washout. I'm going to say my call is tertiary markets, and secondary markets is where you see a lot of pain in the next couple of years because they can't refi them. But small properties, a lot of times investors can hold on to them. It's their bigger properties that had a lot of debt and a lot of limited partners and, that are going to have more pain. But to the point about banking crisis, and I know this is a little bit, coming back to the banks, when you couldn't qualify for Fannie or Freddie, you had two options. One, go bridge debt, which I would say the vast majority of syndications did. But if it was a smaller property like joint ventures, and I'm going to say 100 units or less, a lot of those loans went to local to regional banks instead of bridge debt. So those that had the wherewithal to say, I'm not going to do bridge, I'm going to go to a bank. The question is, what percentage of loans do the regional banks hold compared to bridge debt and Fannie? And it's different across different markets because they're regional banks. But generally speaking, the top 500 regional banks have enough debt on commercial real estate and bonds together, Michael, that if they have to mark to market, i.e., they make the bond available for sale, which is what brought down the three banks that started to fail 2 years ago, or they're not allowed to extend and pretend. Those are the banks that are giving you one more year, let you go to 2025 before your rate resets. If they're not allowed to do that by the government because of bank regulations, and they have to write off both commercial loans and write off bonds, a significant number are poised to fail. Tom Honig, who was the president of the FDIC, he was a voting member of the FOMC, but he ran banks for many, many, many years. He says we're like at a category 4 out of 5 for bank failures. And that was a year ago and getting worse. So I don't want to take it. It's not that I'm totally disagreeing with you, but I think the people that are saying banks aren't really going to fail because they own an asset that's worth the paper. If they gave a 70% loan, it's now 70%. They'll just hold it. They can't necessarily do that from a regulatory standpoint. And they've got both real estate and bonds, and they've got a lot of it. And so when those things can go bad at the same time, and the longer rates are held higher, the more commercial loans will default, the more bonds will have to, be written off, and commercial loans to businesses. Regional banks are the funding arm for small commercial real estate investors, for businesses, and they hold a lot of bonds. So it's like a triple whammy for these regional banks that by and large did deals that were not as stable as Fannie Freddie, not as risky as bridge, but still have risk that they cannot hold off for much longer. So I believe that the risk of a regional banking crisis is much, much higher into the next year or two if rates do not fall than a lot of people are talking about. It's not because I'm doom or gloom. It's because I know the data.
Yeah, the math behind the scenes. Yeah. Well, this is going to be a lot of fun. I had not thought about surviving or praying to the heavens for 27, but I have often said that the pain's not coming till late 25 or into 26, so it kind of ties together.
Yeah.
Anna, where can people find you?
Great. You can find me on your show almost every week. You can find me at social media at Anna Kelly, REI Mom. And if you're looking for real estate coaching or consulting on deals, you can find me at AnnaKellyInvesting.com and can get on my schedule.
Thank you so much, Anna. You're amazing. We'll talk next week.
Thank you.